Hello everyone, welcome back to my YouTube channel at Illumination of NG. Don't forget to subscribe to my YouTube channel and also click on the notification bell so that you can be notified whenever I drop a new video. Okay, so welcome to part 2 of the video on end of the year adjustment. Okay, so we're going to look at drawings as part of the end of the year adjustment. Drawings, we know that drawings, okay, drawings. We know that there are times whereby the owner of the business may decide to withdraw part of the product, okay, or part of the goods purchased from the business, okay, for his personal use, okay. So drawings occur when we have uh, individuals take part of the company's items for personal use. So what we do is that we recognize this in the we deduct the purchases account, okay, for goods being withdrawn, and we also deduct this from the capital account, okay, that is when in our balance sheet or statement of financial position. What we do is to just debit, is to deduct this, okay. We deduct from the deduct from the capital in the balance sheet. The balance sheet, okay. So after we must recognize that in the purchases account, so as drawings. So we're going to what we're also going to have that deducted from the capital account. So the next one is to look at accrual and prepayment for incomes. Now when we talk about let's first talk about accrued income, okay. So for accrued income, accrued income. Now accrued income are income earned by an organization or individual, but it has not been paid, okay, at the specified period of time. So this accrued income means the individual organization is still being owed for this income. So in this case, we're going to recognize accrued income as an asset. We recognize as accrued income as an asset. So what we do is to add it back to the income in the POL account and also recognize it as a current asset. In the case of prepaid income, for prepayment, prepaid income means that the organization must have been paid in advance, okay, for a work that has not been done. For example, if you have a contract earned by this organization and the contract is supposed to take 2 years, 3 years, the organization has not done the work, but it has been paid in advance for that 3-year period. In this case, this is a prepaid income. So the prepaid income will be what? Deducted from the income in the POL or income statement, and the prepaid income should be recognized as what? As a liability, because it has not been executed, but the payment has been made to the organization for a work that has not been done. So it's a payment in advance, and this is seen as a liability in the statement of financial position. So in the case of provision for bad debts, in the case of provision for bad debts or bad debts, okay, we know that bad debt is an expense. So bad debt is seen as an expense in the account. So we're going to recognize bad debt in the income statement as an expenses, and we're going to take that from the debtors. So what we do is to write them off from the profit and loss account or loss account, and then take it away from the debtors in the balance sheet. The same thing applies to provision for bad debts or provision for doubtful debts. Okay, so we take it away, deduct from what, from the um, profit or loss account as an expense, and also we'll deduct it from the debtors account in the balance sheet or statement of financial position. So for provision for discount on either the debtors or creditors, so what we do is that we for provision of discounts for debt for creditors, what we do is to add the discount back to profit, and this is like a discount receivable. This is as a discount receivable in the case of provision for discounts on creditors. Okay, provision for discount on debtors. This is also seen as an expense, okay, because like someone is owing you for a debt, but because you want that person to pay you the money as quickly as possible, you try to reduce the burden by giving a discount to the debtor so that the debtors can pay you the remaining balance. Okay, so this is also an expense, okay, which you're going to take away from the debtor's account. So in the balance sheet, so what we're saying is that if you have a debtor that is owing you 100,000 naira, for example, you're not giving they're not giving the debtors a condition, debtor a condition that if he's going to pay you within 1 month, okay, we're going to reduce the debt by 10%. Meaning that we're going to take away 10,000 naira from the 100,000 naira debt. This is an expense, okay, in the income statement, and it will also be recorded as what as a deduction in the value of what amount of debt that is being owed to you. So let us move on to the next one, so we can do some workings. Okay, so what are the reasons for end of the year adjustment? Number one is to ensure that clothing stock are being valued at the end of the year. Number two is to make provisions for the acquisition of non-current assets. Number three is to ensure that the application of the double entry principle is adhered to. Number four, to ensure that the accounts are prepared in line with generally acceptable accounting principles, also known as GAAP. Number six is to ensure that all accruals and prepayments are duly recognized during the financial year. And the next one is to ensure that all incomes and expenditures are duly recognized in the books of accounts. So let us move on to the next one, which is let us quickly look at this question, okay, that has additional information or end of the year adjustment. Now, we have this question which says IGI Nigeria Limited has a stock at the beginning, which was 500,000. We now have some additional information that is the company's closing stock is 10% of its opening stock. Also, the organization has a markup on the cost of sale as 10%. This is used to determine the sales figure. You are required to prepare the income statement and post to a balance sheet extra. Okay, so for us to be able to prepare this, let us say solution. Okay, so we have our income statement. Okay, income statement. We have revenue, new or turnover over. So let's put it this way. We have less cost of sales. Less cost of sales. Okay, so we're going to have our gross profit. Okay, so but for us to calculate the cost of sales, now cost of sales, okay, so this is opening stock, okay, add purchases if you have purchases in the question. We also have I'll give us cost of goods available for sale less closing stock. Closing stock. Then we have cost of sales. So from the question, what's the opening stock? Opening stock is 500,000. Okay, we have 500,000. Okay, so we have 500,000 as the opening stock. 500,000 here. We don't have purchases. Okay, so our cost of goods available for sale is 500,000. Okay, so we have less closing stock. So what's our closing stock here? Our closing stock is we're told that this is 10% of our opening stock. So 10% of 500,000 will give us what, 50,000. Okay, so then of the day we have a cost of sale of 450,000. Okay, so let us go ahead and so put that there, 450,000 as a cost of sale. Okay, in the question we don't know the revenue yet or the sales yet. We're told that the organization's markup on cost of sale is 10%. That is 10% is our profit on what, on cost of sales times 450,000. So our markup, which is the gross profit, is 45,000. Okay, from what we have done here in this calculation here, 45,000. Okay, so what will now be our sales? The addition of this and this should give us our, so gross profit is 45,000 from here. Okay, so when we add these together, it should give us our revenue or sales, which will be 495. Sorry, addition of this and this will give us 495,000. Okay, the addition of 450 plus 45,000 naira will give us this. That is 495,000 naira minus 45,000 will give us what? 45,000 in gross profit. It's just the same as saying, let's do that there. Profit equals to selling price minus cost price. The sales here in this question is what? 495,000 minus what's the cost price? That is cost of sale for 50,000. So our profit is what? Is 45,000 there. Okay, similar to what we have here. Okay, 45,000 there. So this is how we're going to calculate this, solve this question, and it's very easy and not as difficult as you think. Okay, so we may have various additional information in questions. You may be told to calculate depreciation using what, the formula cost minus scrap value of the assets divided by the lifespan. So you should be able to identify those adjustments and be able to post them. Just know that whenever you're making any adjustments, you have to recognize the adjustment twice. That is, it must follow the double entry principle. Okay, when you recognize one in the income statement, you must also recognize the second arm in the statement of financial position. So thank you very much for your time, and we're going to make more videos on this so that we can further explain to those of you who are our viewers and students who are watching this video. So thank you very much for your time, and have a great day.